Although our portfolio has done very well for the year, you've probably noticed that the pace at which it is increasing now is starting to slow down. So we went from this kind of a move and now it's starting to plateau. And that is because we're moving into a lot more defensive assets, and we're starting to lock down temporarily our portfolio. The valuation of the market in general is getting into nosebleed levels once you compare it to the earnings that are getting reported by the businesses that comprise it. On top of that, we're looking at net export data from China, from South Korea, Japan, the economy from Europe as well. And it's very difficult to see where we're going to have a catalyst that is going to justify the valuation that we have. This whole pricing that we're looking at today is based on an expectation that the GDP will continue to grow meaningfully for this year. And based on what the numbers are looking like for employment and credit card spend, retail stock levels, it is very unlikely that we're going to actually hit it. So it feels like there's a disconnect from the numbers and the valuation. The most likely culprit for this is perhaps government spending. The amount of deficit this year from the US government is going to end up around, it's estimated at around $2 trillion. So when you think of the impact that that kind of money may have in an economy, obviously it's injecting capital. However, this injection of capital does not come without a price, because as I'm sure you know, borrowing money has gotten a lot more expensive now that the central banks are increasing the rates. So every year that the government is running a deficit means that they have to borrow, and the borrowing costs are getting out of hand. So borrowing has to slow down, or the costs to carry that debt are going to be uncontrollable. And this was reflected recently by the news from Moody's that the US debt got downgraded. So as you can see, there are alarm bells going off about the potential impacts of the debt. And if you don't have this debt continuing, then this sugar high, or this impulse, this stimulus that the economy was receiving to offset the recession that is moving from the other side, is going to be unsustainable. And we're going to have to face a potential recession. So there's a tug of war right now going from one side. The government is pushing, trying to continue the economy in a boom circumstance, and on the other side are the central banks fighting back, trying to slow it down by a rate increase, and also by doing quantitative tightening, which is the reverse, or unprinting money, so to speak. And when you see a battle like that with two strong opponents and gravity going the opposite way, it really becomes an opportunity to lock down a portfolio and take a look at the great year we've had, and maybe take a much more defensive stance. So should the stock market continue to rally for the rest of the year, the impact on the portfolio will be smaller. But so will it be if there is a big drop down on the markets. As always, we continue to monitor the businesses that we're invested in, and for the most part, they're all doing very well. It's to no surprise, and I hope they continue to do that. But the positions will not be as large, and it'd be great if we get another opportunity to buy again at low prices and take advantage of that, which we're going to be watching. See you guys on the next video.